The biggest risk in your portfolio may not be what you own, but maybe what you're missing. For decades, stocks and bonds have been the foundation of most investment portfolios, but today's market has changed. Inflation, geopolitical conflict, and supply chain disruptions, along with volatile energy prices, have thrust commodities into the spotlight, causing investors and financial advisors to rethink traditional portfolio diversification. Joining us to explain what's driving these trends and what investors should be watching next is John Love, CEO at USCF Investments. John, welcome back. Great to see you.
Good to see you, Ron. Thanks for having me again.
Crude oil has delivered whiplash performance this year. It's all over the place. Is structurally higher oil the new normal, or are we just trapped in a highly volatile trend?
I don't think it's completely a highly volatile trend. Of course, everything's event-driven this year with the Iran war, obviously, and the back and forth with what's going on. I think actually last time I was on the show, things were getting better. So crude prices were starting to come down. Prices at the pump were starting to come down. And now, obviously, we're back in an environment where it's going back up. Not quite the volatility we had in February when the war broke out, but it's certainly still there. And what we were saying last time was we thought, there's still risk to the upside. I mean, despite the seeming improvements and, looks like we're going to get a deal. And I think, frankly, the fact that the whole world, it needs this to happen. We need the Strait of Hormuz open. And it looked like that was happening. People were, the U.S. and the Iranians were making a deal, and now here we are again. So I think the risk, obviously the market has recognized that now, continues to be to the upside. Structurally, yes, there are things that have changed. Supply chains are different than they were just a little while ago, just 6 months ago. Countries have had to change where they're getting oil from and draw down their reserves and all kinds of things along those lines. The danger right now to the price is, of course, demand destruction. We've seen some of that. That may continue. That may hold the price down. I mean, that's essentially what has to happen now, especially one thing that was going on was, everybody was fretting when the strait was first closed, and it certainly had a negative effect on our wallets, but everybody managed to find ways to either tap those reserves, or Saudis were sending oil across the desert, putting it through the Red Sea. Well, now in the last few days, the Houthis have said no, this time around we're closing the Red Sea, and you've had ships turn around. So now we have both the Strait of Hormuz and potentially the Red Sea effectively closed, and this, from a supply standpoint, is worse. So the demand destruction is really the question: is how much does that come into play? How long does this last? But we think risk is still to the upside, and until there really is, and next time the market's not going to trust a deal either. There's going to have to be real effects, I think, before we see the price really coming down. So it's going to be an interesting couple of months as we move forward and see what happens.
Great points. Shifting to UMI, which focuses on midstream assets in the energy infrastructure arena, and a totally different exposure than the pure play of physical commodities. So how does the toll booth cash flow strategy provide a buffer for investors when the energy market gets volatile?
Well, the nice thing about UMI is, as you said, there's that toll booth. And the companies that are in the portfolio, a lot of them have these inflation pass-through contracts, for one thing. For another thing, they tend to be long-term. So you get a little stability in the product that you don't get with necessarily the underlying prices. So if you look over the last 5 years, and you look at what energy has done, there's correlation to energy, certainly, but it's less volatile than, underlying, oil, natural gas, you name it. It's also, like I said, in some cases they can pass through, actually in many cases you can pass through inflation. So it bears that up well. And you still have that energy exposure. So it's kind of a nice way to look at it from for an investor looking for total return over the last 5 years. It's beaten the S&P 500. It's right up there with oil itself, but a lot of oil's gain has happened in the last 6 months. So you get this more less volatile trend up that we've had over the last 5 years. They're good companies in the portfolio. So, of course, there's some equity beta there. But it's another way to play energy and maybe focus for people focused on stable income and also still participating in the energy story when there is an upswing. It's a nice way to do it.
One of the ETFs that we talk about quite often on this channel, and we've discussed it before, is ticker symbol SDCI, which acts as a phenomenal core diversifier for traditional portfolios that might be heavily weighted to stocks and bonds and maybe real estate. The fund has consistently outpaced its peer group. It's even garnered a 5-star Morningstar rating. And tell us more about the secret sauce behind SDCI. Give us an update. What's been driving its impressive results?
Well, SDCI is designed to sort of combine the best of active and passive. It is passive, and then it tracks an index, but that index doesn't hold every commodity in the universe. It actually rebalances to about half of the most liquid commodities in the universe on a monthly basis. And it's designed to look for essentially relative scarcity. It's like, where's the scarcity story the best every month? And so that leads to maybe 2 or 3 commodities turning over on average a month. But we're kind of concentrating on what is in low supply relative to demand. And if something's in low supply relative to demand, it has much more propensity to go up in the future. And so if you look at the long-term result of SDCI, that's been the case. It's had a great 5 years. It is not designed to be a replacement for an oil fund. So when you have oil go gangbusters, that might be a short-term thing where SDCI doesn't perform as well as funds with high energy concentration. But we're giving you that broad exposure to every commodity sector at all times, and to a range of commodities that are not correlated with each other. So if you look at the performance and you look over time, you see that on average we're tending to hold those winners and hold them longer and avoid the losers. And it's worked quite well for us for quite a period of time. So we think that's really the best way to invest in commodities is have good beta by being in all sectors to the commodity universe, but don't try to hold everything all at once. Also, it's very difficult to make active decisions and say, we think this, we think that. We just used a systematic approach to say, hey, this is where the scarcity profile looks most positive. Let's go there and let's re-examine it every month. And let's equal weight this portfolio so that we're always giving you equal degrees of freedom in terms of the possibilities that are out there.
Makes sense. Now, as a group, commodities have had a massive run this year. They've outperformed most major asset classes, from stocks to bonds to real estate. But gold has been one of those glaring outliers, with prices modestly down. On paper, the long-term bull case still looks solid. We've got global debt out of control. U.S. national debt just crossed 100% of GDP. That's a level not seen since World War II. So if structural debasement thesis is alive and well, why is gold stalling? And could gold's pause maybe be a compelling opportunity for those that missed the first run?
Well, I think you said it just perfectly. And the only thing I'd add to your list is that central banks are still buying, and they're happily buying at a discount to the trajectory that gold was on for the last 3 years. So I think there's really two things going on. One, everything you said is true. I mean, I think this massive uncertainty, all this change that's going on in the world, debasement, but not only that, pivot away from the dollar to some degree, and just massive uncertainty in so many markets. You'd think gold is the ultimate, one of the ultimate fear hedges. So this year has been frustrating. And I think the two things are, one, over the last 3 years, gold did do exactly what you expect it to do. And it did, it had a really significant rise over 3 years. So at this point, it's just sitting. It was at all-time highs. So it's given a little of that back. But if you look over a longer time span, gold in your portfolio has done what you would want and expect it to do. Now, as to this year specifically, I think it really comes down to, is the Fed going to have to raise rates? Because inflation is persistent. It's hanging in there. It's even it went down last month, but it's going up. So it's really a question of, are rates going to go up? Because gold is not an asset that gold itself does not deliver income. There's no earnings on gold. So if fixed income is paying out a yield, then just sitting in gold tends to be less valuable to an investor than an environment where rates are lower. So I think there's been that fear of rates rising, and we'll see if that ends up happening or if the Fed has kind of shifted its mentality. But there's so many other things, so many headwinds to the global economy and just everything in the world right now. I think gold's kind of taken a pause. I don't think that its importance has been minimized, and the fact that central banks are still buying it, I think, is a telling sign.
Ticker USG offers something most gold ETFs miss: gold exposure with income potential. Tell us more about USG.
Sure. Well, it's honestly very simple. We buy gold futures. Sometimes we actually let them expire and take gold warrants into the portfolio, which is somewhat equivalent to when you have a physical gold receipt for gold in a vault in London or somewhere else. But we also write call options on our gold futures positions, and that allows the fund to earn income as as gold is doing what it does. So in a runaway market, it might be a little harder to keep up, but in a sideways market or a steady gain or a down market, you're earning this income on top of the gold futures position, and that can actually for investors that I want gold, but I don't like that it doesn't produce income. This is a solution for that. So that's who USG was designed for. We've heard from folks that that's something that people are looking for. That you have your gold bugs that are going to keep the gold under their bed, and or in the vault in the basement. But there's plenty of people who want the gold exposure. They don't need it in the house or in a vault somewhere, but they want that income to go with it.
As you know, the commodity fund space is getting crowded, but USCF Investments has this distinct advantage of being an industry pioneer. Aside from that deep institutional experience, what is the foundational investment philosophy that separates USCF from the pack?
Well, I think it's our focus on commodities. We are primarily have been a commodity shop. We've been our first fund was launched over 20 years ago. We've launched many commodity funds since then. And it's a belief that commodities are more important in portfolios than I think a lot of investors think or give them credit for. And a lot of people have zero allocation to commodities. We believe that the case for commodities is such that zero is not the right answer. You want to look, at least consider commodities. And the reason is really what you mentioned earlier. It's that diversification story. Once you go past stocks and bonds, the next thing you look at, I think you want to have some diversification away from those two asset classes. And commodities at times are one of the best diversifiers out there. You look at 2022 as an example. It's a year when stocks and bonds were both down significantly. Meanwhile, commodities were up. The Bloomberg index was up 16% or so. SDCI, our fund, was up over 30%. So that was a great example of commodities doing what you want them to do, adding ballast to your portfolio, when in that year, everybody thought, bonds are what's going to protect me. And you had a 60-40 portfolio. The 40% didn't do its job. In fact, it hurt your return even more than you would have expected. So that's not always the case, but we think, if you look at the long history of commodities, there's a very compelling use case for having them in your portfolio. Equity-like long-term returns, similar volatility if you invest in a broad swath of commodities. Single commodities are obviously going to be more volatile, just like any single stock. But if you look at commodities over the long term, you really do have a good investment case. You also have typically an inflation hedge, especially surprise inflation. If inflation is running 3% and it jumps up to 6%, that's when commodities really shine. Or even doesn't have to be 6%. It can be 3 to 3.5%. But commodities are that input to the global economy. And sometimes some of them move with stocks. Sometimes some of them move completely opposite from stocks. But you put them together and you have really nice tool for your investment toolkit.
John, thanks for joining us and keep up the good work.
Thank you, Ron.
To learn more about the commodities strategies we discussed, along with USCF's entire ETF lineup, visit USCFinvestments.com or subscribe to USCF's Substack. That's what I read. You can get market insights, portfolio ideas, and the latest commentary. I'm Ron DeLegge with ETF Guide TV. Thanks for watching. We'll see you on the next episode.